Each week we take a good hard look at one top 30 company and ask the question, should I hang on to this stock or is it time to give it the heave-ho? We're building what I would call the perfect portfolio, and tonight the spotlight is not on one share but actually the big four banks. Joining me in the studio to dissect these stocks is Simon Cooper from Chancellor. Simon, thanks for joining us.
Thank you, Peter. Nice to see you.
Okay, well, my last guest, I asked him what his feeling is about what the market's going on at the moment, how he thinks it's developing and what he sees happening down the track. What's your feeling?
We're probably a little more optimistic.
Yeah.
The market certainly took a significant decline. The All Ordinaries fell, for instance, 55% from its high in November 2007 to March, which is very significant. Short term, we've seen a nice correction, 25%.
But of course, if it drops 50%, you need to come back 100%.
Correct.
So 25% is a mere bagatelle, really. It's nice it's happened, but long way to go.
I checked the market tonight. In fact, we're still down 45%.
Yeah.
And by any historical bear market, that's still a significant pullback. We do appear on the economic front to have some snippets of good news. And certainly the confidence has picked up, and on that basis we think that some steady buying, we tend to be consistent buyers rather than trying to pick the bottom and the top to buy and sell. We are continuing to recommend the clients buy. We expected some sort of pullback. We've seen 7.5% from the June high.
For Australia, we've come back 7.5%.
Yeah.
And the Yanks have gone back a bit more than that.
Yes,
too.
they have. Maybe we could see a bit more. Could come back another 5-10%. But as it comes off, good opportunities to buy, particularly in the core stocks.
What is your general philosophy towards investment?
Well, very much long term, looking for yield so that at least investors get a cash return while they're waiting for longer term capital gains. The key thing too is that it's the dividend growth that's going through in the longer term. So the dividends this year will 10 years time be 2, 3, 4 times greater.
At the moment, if someone goes to the newspaper and looks at dividend yields, some of them look absolutely fantastic. But I guess you can't rely on some of those big percentages because the share prices have fallen by so much. What's your attitude on reading current dividend yields on the expectation that they might be sustained in the future?
The unfortunate thing is the newspapers use historic information. Yeah. So in many cases, they're using the yields that were paid for the year to June 2008. Or even the first half of 2008-9.
That's a good point.
Then applying that to the current lower price. Now, part of what's pushed the prices down, not only investor concerns about the economic outlook, but there's been a number of dividends have in fact been cut, both in the interim, and we are expecting further cuts in the final dividend.
Okay, well given the fact that you have a focus on investing long term and also that you're a dividend watcher, let's go through the big four banks and see what your position is. Let's start off with the Sydney one, CBA. What do you think?
That's one of our favoured banks. That and Westpac are our two favoured.
It's not a Sydney-Melbourne thing?
No, not at all. In fact, they're all far more nationally orientated, as you know. To me, the couple of issues about the banks. First of all, they represent about 22% of the market. So to not invest in banks, you are not investing in a significant slice of the market. Yeah. The second point is banks have had two major issues, and that's probably why they fell as heavily as they did 12, 18 months ago. One is the risk of being able to borrow money. That has been largely resolved thanks to the government guarantee. Banks can now go into not only domestic but international markets and say, I would like to borrow your money and you've got an Australian government guarantee that I'll repay it, which is a pretty strong security. The other side is the capacity to lend, or more particularly how safe the lending they're doing. And there have been some issues. We've seen some major corporates fail, but it's of interest there, other than the timber companies, Timber Corp and Great Southern, there's really been no major collapse for some months. You've got to go back to Babcock and Brown, Allco Finance and even ABC.
And they were bad even before the crash, really, weren't they?
Yeah. So in a sense, touch wood, we may not have seen the end, but certainly we seem to work through those. The other area of concern is the small borrower, the mortgage loan. At this stage, unemployment hasn't risen as much as expected, and therefore the pressure isn't coming on mortgages. Will that get worse? Not sure, but certainly the signs are it's not going to be as bad as expected.
Well, certainly tonight you would have been more negative if the swag of economic data we've seen over the last few months had been negative, because you would have thought small businesses would be in trouble, they wouldn't pay their debts, and would have affected bank balance sheets. So, in a sense, the economy is actually shoring up your confidence as well.
Absolutely,
yeah.
Absolutely. But remember, it has been helped by not only the government direct stimulus, but also, for instance, the first home loan buyers. So we're seeing property prices hold up, and that again is protecting banks with their mortgages, particularly as they've gone away from lending the excessive percentages of valuations. It's making their loans much safer, and therefore we suspect that there's obviously going to be further losses, but perhaps not as bad as might have been thought 3 to 6 months ago.
And the housing finance numbers this week indicate that investors are starting to come back in the market.
Absolutely,
as well.
Absolutely.
All right, so I guess you put Westpac in the same boat. Well, what about Westpac's connection with St George? Is that a plus or a negative on your calculation?
We think it's a plus because putting it now in overall terms, market capitalisation, for instance, it's about the same size as CBA. So they're getting the benefit of size. There's some synergies to be had, even though St George has been run as a separate bank. There's still synergies in the overall business, in borrowing money, for instance, and so we think that will be positive. And Westpac, probably of the four majors, has had the least exposure to the big problem corporate failures that we've seen.
Okay. Now, what about ANZ? That's an interesting one, ANZ. What's your view on ANZ?
A number of clients hold that, and we're quite happy for them to hold it. There is a slightly bigger risk factor, but it's marginal. And I guess those investors who go into that stock have the potential that if ANZ comes through all their problems, and they've certainly got over one of the issues on the announcement today, raising $2.2 billion, again puts them in a strong position. And if Mr Smith is successful in going into Asia, where he has considerable expertise, then the rewards may come through. However, we feel that CBA and Westpac are the slightly less risky of the four majors.
Okay, let's move to NAB.
NAB has, from being one of the best banks of all going back a decade or more, has had continuing issues, and we think at this stage it's our least preferred. Having said that, it doesn't mean we don't like the bank. Again, many of our clients hold it, but it's just, we think on new investment, CBA and Westpac are probably the preferred.
Okay. When it comes to the banks beyond the top four, like the Suncorps and the Adelaide Bendigos, do you think there's value there if securitisation comes back, or if the government decides to offer them a AAA backing? Do you think these stocks have been oversold and may well have some value?
Difficult. At the moment, they are really in a very difficult situation. They are paying a guarantee of up to 1.5%, whereas the big four are paying 0.5%. So those banks have to go out and effectively pay 1% more for their money, net, and then turn around and, in order to get the deals, they may have to actually offer the money at a slight discount, and that puts them in a very hard position.
One last question before we get off the big four. The dividend situation. Westpac and CBA, do they fit your dividend expectations?
Sure. They're both on good yields. The yields are... The dividends are likely to come back this year. That is the 2009-10 year, but go up after that quite significantly. I think, in fact, both those banks are very interesting examples. I went back and checked, and CBA, that was listed in 1992, in its first year was paying 40 cents a share. Last year it paid 266 cents a share. That will come down, I think, about 220 this year. But while I can't say where the price will be in 5 years, I am very sure that unless we have a depression, and that doesn't look very likely at the moment, that we will see a higher dividend we're getting now. So investors are getting a return 5.5%. grossing up for the franking credits up around 7.5–8%, which is double what they get on money on deposit.
Great stuff. Now, so therefore we're ticking CBA and Westpac and we're putting question marks over ANZ and NAB. Now, before you go, mate, I've got a viewer question or two. The first one I'll do, but the second one I'd love you to join me on. So time now for this viewer question, and this one comes from Wayne. And earlier on the program we had a discussion about whether or not to fix your home loan or not. And in that particular time, I talked about comparison rates, and Wayne wants to know, or wants me to explain, what is the comparison rate? Now, the comparison rate really should be called the real rate or the true rate of interest. But as banks can be quite deceptive in the way that they communicate with us, they've come up with this term comparison rate. What the comparison rate is take the advertised rate that you might see in a newspaper. At the moment, you might see home loan rates at 5.2%, and in a lighter box right beside it, you'll have comparison rate, say 5.35%. The 5.35% actually has the fees and other charges that will go with that home loan. So that is the true rate, Wayne. So when you're going for a home loan, make sure you find out exactly what the comparison rate is, because that's the rate you're actually going to pay on your home loan. Now, another question, and once again I'm going to ask Simon to join me on this one, is from Natasha, and she wants to know about volumes trading on the share market. And she asks, will things ramp up and gain momentum as the dividend season arrives, or can we expect investors to stay on the sidelines and prices to stagnate for longer? Interesting question, mate.
Very interesting.
Because the volumes have been really low, both in the USA and here.
Yes.
What's your feeling?
Remember, when talking about volumes, there's been a massive amount of investment in these various capital raisings, be they rights issues or title issues or share purchase plans, and that's taken a lot of money that might otherwise have gone directly into the market. There are a number of funds that invest for dividends, and therefore it's likely there'll be some increase in activity as those funds buy prior to the dividend and could be selling afterwards. So that's one factor. I know I've seen the reports from some of those funds, and they claim that typically about a month after the stock goes ex-dividend, it has recovered most of the dividend effect. In other words, if you hold the stock for that 2 or 3 months in a normal market, which we're probably not in at the moment, that the stock will be priced similar after 2 or 3 months to what it was before it went ex-dividend.
Okay. Now, given the fact that we've got reporting season coming up both in the USA and here, if those reports are better than expected, what do you think is going to happen to volume?
I think it will encourage investors. There's certainly money available for investment, superannuation contributions.
Do you think the super funds are holding a lot more cash than they really want to, but they're being cautious at the moment?
Yes, and they may be cautious for longer, so I don't think they're going to rush in. But certainly, as we see more signs of some pickup in the economy, and more particularly in corporate profitability because of companies raising capital. Don't forget, of course, raising the capital means there's more shares to share around the profit and the dividends. So in a sense, the more shares that are issued, the lower the earnings per share will be, and lower therefore the dividends will be. But certainly, if the results were better than expected, typically what will happen is we'll see some good results and we'll see some very surprisingly bad results.
That's right.
So it'll be a bit mixed bag. But certainly those companies that report better than expected will undoubtedly see increased turnover.
Yeah, we'll probably see more volume. Simon Cooper from Chancellor, thanks for joining us on Switzer.
Thanks very much, Peter.